What if one of the safest investments in the entire world is slowly becoming average and losing its future growth potential right now? Apple is a trillion-dollar company trusted by millions of investors, but that does not automatically mean it is still a great opportunity today. So the real question is simple. Should you invest in Apple in 2026, or is it already too late to make real money? Many investors believe Apple is always a safe bet, but safety and high returns are not always the same thing in the stock market. Apple did not just build products, it created one of the strongest ecosystems. When you buy one Apple product, you are slowly pulled into a system where everything works together and becomes difficult to leave.
4567, you can tap here.
Okay, tapping now.
Thank you, you're all set. From payments to music and cloud storage, Apple has built a lifestyle that people rely on every single day without even thinking about it. This is exactly why Apple generates massive and consistent cash flow, making it one of the most powerful businesses in the world. The company continues to dominate in profitability, and that is one of the main reasons long-term investors keep buying the stock. Apple earns money from hardware like iPhones and also from services, which brings stable and growing income over a long period of time. Apple's business model is built on two powerful streams: hardware that brings users into the ecosystem and services that keep generating consistent income long after the initial purchase is made. Services like the App Store, subscriptions, and cloud storage create predictable revenue, which is far more valuable for long-term investors than one-time hardware sales alone. Every new iPhone sale is not just a transaction, it is the beginning of a long-term relationship where the user continues spending money inside Apple's ecosystem. That is why Apple is focusing more on services today, because recurring income is more stable, more predictable, and significantly more profitable over time. Over the past year, Apple stock has delivered steady returns, but the growth is no longer explosive, and that is something investors need to clearly understand before buying. Compared to companies like NVIDIA that benefited from the artificial intelligence boom, Apple's growth looks much slower and more controlled, which changes expectations for new investors. Apple is no longer a fast-moving rocket stock. It behaves more like a massive ship that moves steadily forward but cannot suddenly accelerate like smaller companies. This stability can be a huge advantage for long-term investors who prefer predictable growth instead of extreme volatility and unpredictable market swings. That is exactly why many experienced investors choose Apple as a foundation in their portfolio, using it as a stable base for long-term wealth building. However, one important issue is that Apple's growth is clearly slowing down compared to earlier years, and that creates new risks for future returns. When a company becomes extremely large, maintaining high growth becomes much more difficult, and Apple is already one of the biggest companies in the world today. For Apple to double in value, it would need to add trillions of dollars, which is far more difficult than smaller companies growing at a faster pace. This is why investors must adjust expectations, because Apple is no longer a stock that delivers extreme returns in a short period of time. Instead, Apple offers something different: stability, consistency, and long-term compounding that builds wealth slowly but reliably over many years. The future of Apple depends heavily on new technologies like artificial intelligence and how well the company integrates them into its existing ecosystem. If Apple successfully uses AI to improve user experience, it could unlock a completely new wave of growth that drives the stock higher again. However, companies like Microsoft and Google are currently ahead in artificial intelligence development and innovation. This means Apple must either catch up quickly or create a unique approach that differentiates it from competitors in the evolving technology landscape. Apple is also investing in wearables and new devices, which could become another important source of revenue in the future. Products like augmented reality or virtual reality could open new markets, but their success is still uncertain and depends on consumer adoption. One of Apple's biggest strengths is its ability to generate enormous amounts of cash every single year without relying on unpredictable business models. Apple returns part of this cash to investors through dividends, which provide a steady stream of passive income over time. The company also buys back its own shares, reducing the total number available and increasing the value of each remaining share over time. This strategy may not look exciting, but it is extremely effective for building long-term shareholder value in a consistent and predictable way. That is why Apple is often considered a core holding in many portfolios, especially for investors who prioritize safety and stability. For beginners, Apple can be a great starting point because it is easy to understand and less volatile compared to many other stocks. However, if you are looking for fast gains or explosive growth, Apple may not deliver the kind of returns you expect in a short time. Chasing quick profits with a slow-moving stock can lead to disappointment, which is why understanding your strategy is extremely important. A smarter approach is to combine Apple with other types of investments to create a balanced and diversified portfolio. This allows you to benefit from stability while still having exposure to faster-growing opportunities in the market. For example, adding an index like the S&P 500 can provide broad exposure to the entire market and reduce individual stock risk. Instead of investing all your money at once, a better strategy is to buy gradually over time using a method called dollar cost averaging. This approach allows you to take advantage of market dips and avoid the risk of buying everything at the highest possible price. Successful investors focus on long-term results and ignore short-term noise, which is especially important when investing in stable companies like Apple. Over time, small consistent gains can grow into significant wealth thanks to the power of compounding and disciplined investing. Patience is one of the most important skills in investing, and Apple rewards those who are willing to hold for many years. Short-term traders often miss out on the biggest gains because they focus too much on daily movements instead of long-term growth. Holding strong companies through market cycles is one of the most proven strategies for building wealth over time. Even when markets become volatile, companies like Apple tend to recover due to their strong fundamentals and loyal customer base. Apple's brand is one of its biggest advantages, creating trust and demand that competitors struggle to replicate. This brand loyalty translates directly into revenue because customers continue buying new products and services over many years. Apple operates globally, giving it access to massive markets and allowing it to generate income from different regions around the world. This diversification helps protect the company from economic issues in any single country or region.
Continuous innovation is still important, and Apple must keep improving its products to maintain its competitive advantage.
Today, we unveil our Ultra phone, faster and cheaper.
Competitors are closing a gap.
If competitors release better or cheaper alternatives, Apple's, which is why innovation cannot slow down. Understanding both strengths and risks is essential before making any investment decision, especially with a company as large as Apple. You should always match your investments with your personal goals, whether that is growth, income, or long-term stability. Making decisions based on emotions instead of strategy often leads to mistakes that could have been easily avoided. That is why having a clear plan is more important than trying to predict short-term market movements. A well-balanced portfolio gives you both protection and opportunity, allowing you to grow your capital without taking unnecessary risks. Apple fits perfectly into a long-term strategy, providing stability while other investments focus on higher growth potential. Combining different types of assets creates a stronger overall portfolio that can perform well in different market conditions. Tracking your progress helps you stay focused and avoid making impulsive decisions based on short-term market fluctuations. Over time, disciplined investing can lead to impressive results, even without taking extreme risks or chasing hype. Confidence in your strategy comes from understanding what you own and why you own it in your portfolio. Clarity reduces stress and helps you stay consistent, which is one of the biggest advantages in long-term investing. Ignoring unnecessary noise allows you to focus on what really matters, which is long-term performance and steady growth. Apple may not be exciting anymore, but it continues to deliver reliable performance that many investors depend on. While other stocks may offer faster gains, they also come with higher risk, and not every investor is comfortable with that level of uncertainty.
So the decision comes down to your goals, whether you want stability and consistency or faster but riskier growth opportunities.
Understanding your priorities will help you decide if Apple deserves a place in your investment strategy today. There is no perfect stock, but there are smart strategies, and Apple can be part of a well-thought-out plan. The key is not chasing hype, but building a system that works consistently over time and protects your capital.
Investing is not about quick wins, it is about making decisions that compound and grow your wealth steadily over the years.
Apple represents stability, and for many investors, that is exactly how they need to succeed in the long run. But remember, even the strongest companies require patience, discipline, and a clear understanding of your financial goals. If you combine knowledge with consistency, you can build a portfolio that works for you instead of against you. The market rewards those who stay focused, avoid emotional decisions, and commit to a long-term strategy. So take your time, make smart decisions, and remember that real wealth is built step by step over time. And if you want to become a smarter investor, start focusing on strategy instead of hype and build something that lasts.
You can stand under my umbrella.